and welcome to the video about what trading risk is. Let's take a look at the key learning outcomes of this presentation. Why you should keep a check on risk. What are risk-reward ratios? It takes money to make money. Short-term versus long-term risk, and why your risk is important to you, not the industry. Trading risk can be simply described as the amount of money you are willing to lose compared to how much you are trying to gain by your trading activity. Trading is unlike fixed odd betting. If you were to back something to win at a certain price, you would stand to make the amount of your stake multiplied by the odds or lose your stake. So £10 on a 5-to-1 bet returns you £50 plus your stake, and your risk is £10. With trading, however, you can lose significantly more than your initial stake or investment. The amount of money you stake in the markets will change as the markets do. If you are on the right side of a move, you make money. If you are on the wrong side of the move, you stand to lose money. Risk, therefore, is the concept of managing this process. We all know that it takes money to make money. Trading is no exception. To put a trade within the market, you have to cover your exposure, or what we call margin. So if you want to buy or sell £1 a point in the euro against the American dollar, for example, depending on your broker, you may need £200 to £300 in your account to do this. You're not spending that £200-300, but rather using it to trade £1 in the market and to cover what may happen. This means that if you want to trade £10, £50 a point, the amount of money you have to hold in your account will have to rise accordingly. The money you hold in account dictates the size you can trade and also what you can risk to lose on your unsuccessful trades. Remember that your risk should equal your potential reward. The bigger the risk you take on, the bigger the return. The amount of money you risk when trading should be down to you. There are rules and ways of managing risk, but only ultimately you will be able to decide how much money you invest in your own trading. You can start trading with a few £100, or you can put in a few £100,000. The amount of money you deposit will directly affect the amount of money you can make, but also how much you can lose. Think of it this way. Why do so many new businesses fail? They run out of money. Why do many traders fail? Guess what? For the same reasons. When to stop trading is where the whole risk management comes into its own. Have you ever said while trading, if only I had more money, more time, if only I knew that would happen? Why is the market going against me? This is why you have to have a plan about what you're going to risk before you ever put a trade on. There are no take-backs within the markets. Once you have bought or sold, the market will move whether you like it or not. You can lose significantly more than you want in a very short space of time if you're not prepared. A lot of traders get confused when talking about investing or speculating. Speculating is more associated with trading. You're not looking to own anything. You're looking to take advantage of price movements. This can be in any asset class, and you can buy or sell. This is short-term trading or speculating. You buy at point A, and if that goes up to point B, you stand to profit from the difference in prices. A quick note here to make sure that we do not confuse trading with gambling. Investing is more long-term. If you are buying Apple shares as an investment, then you will be holding these for a significant amount of time, months, years, maybe even decades. It is not as easy as it sounds though, as you would need to have these psychological characteristics that will help you go through prolonged periods of falling markets and not be tempted to liquidate your positions. A lot of traders, on the other hand, find they don't like trading as they don't like to see big swings in their money. The shorter the time frame, the more movement you will see on your money. The longer the time frame, the smoother the fluctuations may be. Trading risk is significantly different to investing risk, and this should be clear from the outset. When you are investing then, you are taking into account a significant amount of time. You build a portfolio and you balance out the risk. This may mean having some cash, property, bonds, shares of all different types of investment. The longer you hold these investments, the more money you are generally hoping to make. Moreover, any big swings will tend to move towards the average mean, and so your portfolio or individual position will move more smoothly. The risk you manage is both in time and by levels of diversification. And by that, we mean that one should not be putting all of his or her eggs into one basket. This is not the case when speculating or trading. Let's now take a look at the factor of time. Time when trading is your best friend and your worst enemy. The longer you hold your trades, the more potential money you can make, but also at the same time, the more risk you take. When trading, unlike investing, you can be in the markets for minutes, even seconds. The more time you're exposed, the more you're risking your capital. So while managing your trading risk, there are four main ways of doing it. Using the proper ratios, percentage of account, applying stops, and money amount available. They all have their merits and drawbacks. You should always decide which ones you're going to manage your risk with when you're trading before you actually put a trade on. Having said that, ratios are a simple way of managing both your risk and your expectations while trading. If you use the industry standard trading ratio of 2:1, you're trying to make double what you're risking. So if you're trying to make £200 from a trade, then you will stop, however you decide to do this, when you are £100 offside or in negative balance. You can easily calculate your potential drawdowns, and as long as you stick to a minimum 2:1 ratio, as long as you win 50% of your trades over a period of time, you will still be profitable overall. If you have the ratio negative, so you're risking twice as much as you're trying to make in the long term, if you do not have a very high percentage win rate, an 80% plus, then you might find it very difficult to be profitable in the long term. This is a common mistake among inexperienced traders. Once a position is open, the psychological biases kick in, and so people then cut their profits quickly and let their losses run. Setting your stop or trade risk versus what you have deposited is another way of understanding what you can lose. This does not help you with the upside and how much you want to make, but it does allow you to see the bigger picture. If you risk, for example, 10% of your £1,000 account, then each time you trade, you will be risking £100. This is, of course, unless you have a losing trade. Then you risk 10% of your remaining £900, and so on and so forth. Now it is time to take a closer look at how important our stops are and how we set them. Stop orders are where you place an order at a set price in the market, so the trading platform automatically gets you out at a specified price and therefore loss amount. Stops are good because of their ability to protect you from losing more when a situation gets out of control. If the market trades that price, you're automatically stopped out of that position for a loss. The main issue with stops is that you are left to the market forces. Have you heard of a pin bar or stop grabber, short squeeze? There are all terms for market movements designed to stop traders out of potentially winning trades. This is the trading balance risk you have to strike for yourself. If you set yourself a monetary value stop, then you have to have the discipline to stick to this amount. This is very difficult as nobody likes pressing the button to take a loss. Unlike stops, you have to physically get yourself out of the trade by pressing this button. This takes a lot of discipline. Many times traders use this method but not sticking to it. They then end up taking a far greater loss than they initially set out to. This is more for experienced traders, and even for them, this poses more unnecessary risks. So let's now take a look at how you should be managing your stop loss, or how leave to trade another day. This is often not about a business where you buy low and sell high. It is about buying high and selling higher. Strength tends to produce more strength, and weakness is followed by more weakness. Stop losses in that respect are categorized as percentage stop, volatility stop, for example at Bollinger Bands levels, chart stop at support or resistance levels, and so on. Now say you have already defined your risk parameter. Once you have done that, we use the position size to calculate how far away we will place our stop, right? The trader places his stop or her stop, which is in accordance with his or her plan. Right, huh? Wrong. We should always place stops in relation to the market or our system and not in relation to how much we can afford to lose. The market does not know how much we are staking and in all fairness does not care of how much we are willing to lose. This is a very common mistake among the majority of traders, novice and pros alike. So why volatility stops are useful? On a position, for example, of 10,000 in euro-dollar, every pip is worth $1 and 2% of your account in risk management is $10 of a $500 account, that is. Therefore, the largest stop we can place is 10 pips. But looking at the euro-dollar, the pair more often than not has a fluctuation of around 100 pips a day. So the 10 pips stop would appear to be too tight and we will be losing our position. So we can instantly see that failing to take into account how volatility affects the average movement in each currency will result in a loss, even though in principle our strategy might have been correct in the first place. So, as a final note about stop loss, let's take a look at the 4 tragic mistakes. 1. Placing stops too tight. Traders fail to take into account an underlying's frequent swings and therefore a tight stop results in unnecessary stop loss. 2. Defining stop loss based on our position size. As stated before, the market does not care about the money you can afford to lose. 3. Placing stops too far away or too wide. There has to be a sensible placement of your stop given the specific underlying's past movements. And 4. Placing them exactly at support or resistance lines, as many a trader would think that this is an obvious thing to do, but when something is obvious, it is obviously wrong. So, if your stock has been hit, the reason you had opened this trade is not valid anymore. Without ifs and buts, don't adjust your stops to wider levels. One more time, don't adjust your stops to wider levels. Never, ever. Summing up, once losing trades are inevitable, it is simply part of trading. You can, however, still lose trades and be profitable overall if you have an adequate risk strategy. It should allow you to get into trades with a degree of flexibility, but also protect your capital from significant drawdowns. Combinations of ratios with stop-loss orders are advisable, and only in time will you know which suits your appetite for risk and your trading style the best.